Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Guangzhou Baiyunshan Pharmaceutical Holdings Company Limited annual report. Guangzhou Baiyunshan Pharmaceutical Holdings Company Limited offers a diverse range of businesses and services across various sectors. The company's primary focus lies in the research, development, manufacture, and sale of Chinese patent medicines, Western medicines, chemical raw materials, natural and biological medicines, and intermediates of chemical raw materials. In addition to its core pharmaceutical business, the company operates through multiple segments, including Great Southern TCM, Great Commerce, and Great Health. These segments cater to various aspects of healthcare, such as wholesale, retail, sale, import, and export of Western and Chinese medicines, medical instruments, and pharmaceutical products. The company also invests in the health industry by providing medical services, health management, health preservation, and elderly care. Furthermore, it offers leasing and commercial services, including advertising, loading, offloading, and warehouse services. Its retail chain pharmacy outlets and stores provide customers with a convenient shopping experience for various healthcare products. In terms of food production, Guangzhou Baiyunshan Pharmaceutical Holdings Company Limited produces prepackaged food, dairy products, and beverages. The company also offers herbal tea, tablets, capsules, lozenges, tortoise herb jelly, and other health-related products. Its international operations enable it to cater to a global customer base, solidifying its position as a leading player in the pharmaceutical industry. Guangzhou Baiyunshan Pharmaceutical Holdings Company Limited market capitalization of 48 billion is significantly larger than the average industry peer of roughly 1 billion. This shows that Guangzhou Baiyunshan Pharmaceutical Holdings Company Limited holds a significant advantage in their industry. Guangzhou Baiyunshan Pharmaceutical Holdings Company Limited trades at a lower price-to-earnings ratio of 9 times and a higher price-to-book ratio of 0.71 times relative within the industry. This shows that investors are pessimistic in the industry in general, and we should dive deeper on the reason. Additionally, the stock appears attractively priced, even though it is trading at a higher price-to-book value than it appears. We will need to evaluate if the business earnings is sustainable and if the assets are valuated rationally. Overall, we need to identify if this makes a good investment on the long term, or is it going to be an extended period of low valuation or a value trap, and if it would be better to be investing in its peers than Guangzhou Baiyunshan Pharmaceutical Holdings Company Limited itself. The leverage on the balance sheet appears elevated, with liabilities of 54% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 4.69%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a comprehensive analysis of the extracted summaries. Revenue growth is primarily driven by technological innovation and rising demand in the pharmaceutical industry. The domestic innovative drug sector has witnessed vigorous development, remarkable breakthroughs in quantity, quality, and technology, leading to significant revenue growth. Overseas expansion of domestic innovative drugs has also contributed to revenue growth, with simultaneous improvement in quantity and quality. The company's strong year-on-year sales growth in pharmaceutical products such as Zio-Ki Pill, Baojai series, and Amoxicillin series has been a major contributor to revenue growth. Additionally, the diversification of product layout and new product launches in RTD, functional, and health beverages have also contributed to revenue growth. The company's pharmaceutical commerce segment has seen a 6.21% revenue growth, while the chemical pharmaceutical segment has experienced a 7.35% increase in gross profit margin. The natural beverages segment has also seen a 2.21% increase in gross profit margin. On the other hand, revenue decline is primarily driven by the decline of certain industries, such as the pharmaceutical manufacturing industry and the wine, beverage, and refined tea manufacturing industry. Modernized Chinese medicine and traditional Chinese medicine have also experienced revenue declines of 6.54% and 4.13%, respectively. The company's inventory levels for certain products such as Zio Chaihu Granule, Zai Shen Yu Tai Pill, and Qing Kai Ling series have decreased significantly, contributing to revenue decline. However, the company's increased R&D investment, accelerated market launch of projects in key therapeutic areas, and deepened industry-academic research cooperation are expected to drive future revenue growth. Net income and profit margins have undergone significant changes over the past year. On a year-on-year basis, net income increased by 2.7%, with a notable increase of 5.21% in absolute terms from RMB 2,835,496,163.51 to RMB 2,983,113,594.8. However, this growth was partially offset by a decrease in gains from changes in fair value and impairment losses on accounts receivable. Profit margins have also shown fluctuations. Initially, they improved over the previous year due to revenue growth outpacing cost of sales, selling and distribution expenses, general and administrative expenses, and financial expenses. However, this trend was reversed as profit or loss attributable to minority shareholders decreased, leading to a decline in gross profit margin from 16.57% to 16.12%. Regional variations have also been observed, with a decrease of 0.53 percentage points in southern China and an increase of 1.87 percentage points in eastern China. In contrast, Hong Kong, Macau, and overseas regions saw a significant improvement of 4.49 percentage points. Looking ahead to 2025, profit margins are expected to improve through process optimization, brand coordination, and digital marketing efforts. However, the current trend suggests that net income and profit margins may continue to fluctuate in response to various market and economic factors. Despite some contradictory statements, the most clear and consistent information regarding the company's operating cash flow in 2025 indicates a negative trend. The statement on page 10 explicitly states that the company generated a significant loss of -232,460,774.72 RMB in operating cash flow for the year. This is further supported by other pages, such as page 35, which also reports negative operating cash flow. While there are some discrepancies in the data, the overall picture suggests that the company is struggling to generate positive operating cash flow in 2025. The company's debt level has undergone significant changes over the past year. While bank borrowings and long-term borrowings showed contrasting trends, with an increase of RMB 893,587,066.6, 6.75% in bank borrowings, but a decrease of 8% in long-term borrowings, the total liabilities increased by 38,119,184,543.83 from 2024 to 2025. In terms of interest expenses, there is a discrepancy in the data between different pages. However, it appears that interest expenses have decreased by $16,643,913.46 from 2024 to 2025, according to page 55. Nevertheless, pages 60 and 61 suggest a significant increase in interest expenses over the same period. Despite this inconsistency, one thing is clear: the company's debt level has increased significantly, while its interest expenses have shown mixed trends. The company's performance was mixed across various segments and regions. On the positive side, the biopharmaceuticals and healthcare segment, as well as the TCM business, APIs business, domestic market, international market, and overseas pharmaceutical products in Macau and Vietnam performed exceptionally well. The international natural beverages market in Germany, Australia, Singapore, and Malaysia also saw significant growth. In addition to these strong performers, the East China region, Nanjing region, Chinese medicine segment, natural pharmaceuticals segment, and other business segment all showed promising results. These segments and regions contributed significantly to the company's overall revenue and growth. However, not all segments and regions fared as well. The traditional pharmaceutical segment struggled, while the beverages segment also underperformed. Despite these challenges, the company's diversified portfolio and strong performance in other areas helped mitigate the impact of these weaker segments. The company has a history of paying dividends to its shareholders. This is evident from multiple pages in the extracted summaries, including page references such as 1, 2, 20, 22, 32, and 65. These confirmations demonstrate that dividend payments have been made by the company. On the other hand, there is no evidence of share buybacks. Page 44 explicitly states that the company did not repurchase any shares during the reporting period. This indicates a clear distinction between the company's dividend payment practices and its approach to share buybacks. Concerns about inventory buildup and supply chain disruption have been identified in recent assessments. A significant increase in inventory for the Baiyunshan series has raised concerns about potential inventory buildup, with a notable jump of 98.15%. This surplus could lead to storage issues and decreased efficiency. Furthermore, the reliance on Supplier 1 and Supplier 2 is substantial, accounting for 8.11% of total purchases. This concentration of supply chain risk may leave the company vulnerable in case of disruptions or supplier defaults. Additionally, a decline in inventory turnover rate by 2.56% and accounts receivable turnover rate by 2.24% suggests potential issues with inventory management. These factors collectively indicate that addressing these concerns is crucial to maintaining a stable and efficient supply chain. That concludes the financial summary for Guangzhou Baiyunshan Pharmaceutical Holdings Company Limited. Feel free to comment below, and I will be happy to answer them when possible.